What's going on, everybody? This video is an introduction to futures, so if you're trying to switch from Forex to futures in 2024, or if you just want to learn more about how futures work, then this video is right for you. This is a highly requested video, so I'll try my best to explain it as simply as possible, and then we'll look at some charts at the end of the video to implement what you'll learn in here. I just want to say a disclaimer, this video should be taken as entertainment and not financial advice in any form. I have a full disclaimer in the description below, so please check that out before you watch the rest of this video. So within this, we're going to be looking at a couple different things. The basics, ticks versus points. We're going to look at contracts, how to calculate risk, and then some examples using TradingView. So it makes more sense as we merge them all together. I should have the timestamps next to each of these little subsections here, so if you want to skip ahead, you can go and do that now. All right, first we're going to look at some basics. So futures are a derivative financial contract, and there's underlying assets, including physical commodities and financial instruments, that are the thing that you're actually trading. Contracts entail the quantity of the underlying asset and are standardized to facilitate trading on a futures exchange. This is the direct definition from Investopedia. I'll make sure to link that in the description below. Obviously, NASDAQ, E-mini S&P, and oil are probably the three biggest ones that you've seen everywhere. Now, there are two different types of future contracts, a mini and a micro. The mini is the larger one, the micro is the smaller, and typically a micro is 1/10 of a mini contract. These will have the same movement, but the contract value will be different, and we'll look more into contracts later in this video. Ticks and points. So this is how you quantify the current price of a future contract, and this is most similar to your Forex pips. Points is what you're going to see on the right side of your chart there, as well as time on the bottom. Now there's different amount of ticks per point, and it depends on the asset class that you're using. So something like the NASDAQ has 4 ticks per point. ES also has 4 ticks per point, and CL, which is oil futures, will have something like 100 ticks per point. Now the smallest unit of measurement is a tick, so you cannot go smaller than 1 tick. Some examples of a tick within a point would be on NASDAQ, you'll have your current price, and then in between 1 point, you'll have 0.00, 0.25, 0.5, and 0.75. Now 1 point movement on NASDAQ will look something like this, where we're going from 16,051 to 16,050, and then a tick movement would be from 16,051 even to 16,051.25. So that's how you quantify the movements on NASDAQ. Obviously, it's going to be different depending on whatever commodity you're looking at. So we'll look at some quick examples. So points can be up or down, same thing with ticks. 1 point movement will be like this on NASDAQ, or if you're going up, 9.2 to 9.3. On ES, we can go from 40.40 to 40.41, something on CL 79 to 78. So all these whole numbers would be a point movement. A tick movement would be anything that's less than a whole number. So 16,051 to 16,051.25, 51.5, 51.75, and then finally to 52. Now, ticks are your smallest unit of price, so price will only move in these quarter segments. All right, it will not go any smaller than this, and then the whole numbers are the points. We'll look at the chart really quickly here. So this is NASDAQ. I'll use NASDAQ for the most part of this video as an example. So if you look here on the right side of the chart, these are your point values. And each one is 0.5, and then in between it. So if we go from 16,544 to 16,545, there is 4 ticks in between. You can see that 0.5 is marked out, and then in between there's kind of an imaginary line where it'll jump to each of these segments. Okay, so we can't go any smaller than a tick. And then you can see here between this low and this high is about 10 points. Next, we'll look at contracts. So contracts are the means you trade futures with. This is similar to your lot size on Forex. Okay, so your smallest unit of measurement is 1 contract. And this is what you'll use to trade the indices or commodities, whatever you pick. This rule applies to both the mini and micro contracts. So the smallest unit of measurement on a mini is still 1. Same thing with the micro. And then a little example here is 10 micro contracts of NASDAQ is equal to 1 full mini NASDAQ contract. Now you calculate your risk based on the amount of contracts you have and how far the stop loss is in points. And I'll show some further examples of how to calculate this so you can manage your risk properly. But contracts is what you use to trade it, and you can't go smaller than 1. Obviously, you can have more than 1. You can have 5 or 10, anything like that. So the way you calculate risk is by using the dollar per point value. So So there's different amounts of dollars depending on the future contract, as always. So we'll look at NASDAQ for the most of this. There's tick value and there's point value. You're going to be most commonly using the point value. The tick value you do need to understand, but you're not going to be using it as much to calculate risk. So if you reference the previous slides, NQ has 4 ticks per point, and you cannot go smaller than a tick. And this is also specific to one contract. So the dollar per point value is specific to one contract. Obviously, it's going to increase based on how many contracts you have. But for NASDAQ, there's $5 per tick. That's how much movement in the indice. So 1 tick is going to equate to 5 points per contract, and 1 point movement will equate to $20. Now, this can be up or down. So if you're going long and price moves up 1 point, obviously you're going to be gaining $20 per contract. And if it moves down, you're going to be losing $20 per contract. So if NASDAQ goes from 16,050 to 16,070, and you have 1 contract long, right, because the price is going up here, that's a 20-point move. That would be $400 per contract. Okay, so you're taking your movement of the index of the underlying asset, and then you're multiplying it by the dollar per point. So that equates to $400 per contract, right? So ES is a little bit different. It's 12.5 per tick and $50 per contract. Sorry, per point per contract. Then MNQ is 1/10 of that. So this is your micro NASDAQ contract. It's going to be $2 per point. And your micro E-mini S&P contract is going to be $5 per point. So we're going to look at the equation to calculate risk. This is your contract size multiplied by your dollar per point value multiplied by the amount of points that you're capturing. So for NASDAQ, we'll look at this. We have 1 contract, multiplied it by $20 per point, right? So that's specific to NQ. If you're looking at 1 contract and ES, for example, this would be $50 per point. So 1 contract multiplied by the dollar per point multiplied by the points is how much you're gaining or losing per contract. Okay, so if you were long one or short one and you captured a 30-point movement on NASDAQ, this is how much you would be looking at unrealized profit or loss. So if you use this as your reference, NASDAQ is $20 per point. Micro NASDAQ is $2 per point. If you have 1 contract of NQ and it moves 10 points, then you're going to do 20, which is your point value, times 1 contract times 10 points equals 200. 1 contract of the micro, we move 30 points, that's going to give you 60. 4 contracts of NQ, and we move 10 points, you're going to get 800, right? Because $20 per point times 4 contracts times 10 points equals 800. So if NQ moves 1 point, MNQ needs to move 10 points to gain the same value for 1 contract. So to calculate risk, we're going to use that same equation, right? Contract size times dollar per point times points. And then your distance to your stop loss in points is how much you're going to risk in the trade. So if you have a 10-point stop loss and you want to take a 1 to 2 trade, then you're going to be looking at a 20-point take profit. Now, this is the only thing you can control in order to manage your risk is by choosing your contract size. So there's not really a precise way to manage risk since you cannot drop below 1 contract. It's not like you can calculate a lot size like you can in Forex. So it's a little bit different. My tip to you would be for a range of potential stop loss amounts. So something like if you have 5 points as a potential stop loss or 40 points, I'm using NASDAQ here. It would be to calculate the amount of contracts you want to use to keep the risk same per trade. So if you want to risk $400 per trade, let's say, I would have something like this pulled up and calculated beforehand. So when you want to enter the trade quickly, you already know how many contracts you're going to be using and which type of contract, right? A micro or a mini. So if we have a 5-point stop loss on NQ, then you could use potentially up to 4 mini contracts. And if that stop loss was hit, you'd only be risking a max of $400. Okay. If you had a 10-point stop loss, 2 mini contracts, 20-point stop loss, 1 mini contract. If you had a 30-point stop loss, then we can drop to the micros, right? Because 1 mini is equal to 10 micros. So that you could look at 6 to 7 different micro contracts. 40-point stop loss, you could look at 5 micro contracts. And all of those, if the stop loss was to be hit, it would still only equate to $400. So I would say get used to practicing this on your own and finding out how many contracts and how much you want to risk per trade based on your own risk tolerance. Obviously, this is not financial advice, just for entertainment purposes. But if you were to trade this in a demo, I would say look at finding out how many contracts you're going to use and just get used to the kind of fluctuations in price and entering with different types of contracts. So now we'll look at TradingView, a couple things, how to access TradingView and how to access the different futures contracts you potentially want to trade. We'll look at some chart reading so you can get familiar with counting points. And then finally, we'll look at the demo software that TradingView offers so you can get familiar and comfortable with trading different futures. All right, so if you want to download TradingView, it is a free software you can download straight from their website, tradingview.com. Now, if you want to access a specific futures chart, you can click on this up here, top left, and then search whatever you want to look for. Now, if you're looking for NASDAQ, you can type in NQ, and it'll come up with the current contract. Now, there's a difference between contracts. You have your most recent contract. This will roll over automatically, and this is your month-by-month contract. These ones expire. I would say if you're new to futures trading, just use the ones that have the exclamations next to it so you don't have to worry about rolling over your futures contract. Same thing with if you look at oil futures, there's an exclamation point here, or even ES. You can click on this one right here and that'll automatically roll over the contracts for you. And once you have that pulled up, you do need the live data subscription to access the current live data that's not delayed. I think it's about $5 per month on TradingView. Some prop firms and brokers offer it to you for free, but I would just double check just to make sure. So if you look here, we're currently at 16,482.75, and you can see if I zoom in here, if you watch this right-hand scale, price will only move in those 0.25 ticks for NASDAQ, right? We're not going to see a 0.37. It's only 0.00, 0.25, 0.5, or 0.75. You can see it bouncing up and down here. And if you want to measure how far the current chart is, you can, on your keyboard, if you hold down Shift and then you left click, you can measure a range. And then if you look at that first number, 17.75, that's how many points and ticks we're in. So if you measure this entire range, we're about 41-ish points from the low to high. You can also use a tool down here. It's called the price range tool that if you measure it, does the same exact thing. And if you click off, it'll stay there. But just kind of get familiar with the point ranges, how to look for points. Pretty easy, I feel like, compared to Forex. Just nice whole numbers for the most part. It becomes a little bit easier to look at once you get used to it. If you want to just get used to trading the futures contract on the demo, if you click on this little trading panel section right here and full screen it, you can access the paper trading by TradingView. This is a completely simulated account. Connect to it. You'll have a little demo account here, and as well as if you place the buying and selling buttons on the chart. This is your contract size in the middle, so you can increase it. And obviously the smallest amount is only 1. So if I keep clicking the minus button, we're not going to drop down below 1 contract. Obviously you can go up to 100,000, things like that. I would say just start off with 1 so you can get the feel of the point value. And if I was to short price right here, you can see every point we move, there'll be an increase or decrease in $5 per tick and $20 per point. So from here to here, right, if we take our little take profit section, drag it down, that's 20 points down to the low, right about $400, right? Because 20 points times $20 per point, and we have 1 contract, that's 400. If I added another contract here, you can see it now increases by 1 contract value, right? Because we have 2 contracts times 20 times 20. Right, and then if you were to drag the stop loss, it does the same exact thing where we're going to increase basically about the same amount per point. So in this case, we're increasing by $40 per point because we have 2 contracts. If you want to close it out quickly, you can just click on this little X button, and then we'll close out the full order. Now this red button is for shorting, blue button for long, and then obviously you can adjust the contract size like I said before. Now some prop firms do allow you to link their account with TradingView directly. I believe TopStep and a few other ones that use Tradeovate or Trading Station will allow you to link those, and you can directly trade from TradingView, which is very nice. Others you can't. You have to use a third-party software, which isn't the worst, but you do probably want to get familiar and comfortable with using that platform and how they take profit, stop loss, and calculating points. There's not going to be any difference in how they function, just the look sometimes can confuse you. So just play around with it and see how it feels before you actually go into actual demo trading. All right, so that'll do it for today's video. If there's anything that I missed and you'd like to share, or if you have any questions or concerns, please leave them in the comments below and I'll try and get back to you as soon as I can. My Discord and private group is also linked in the description. I live stream almost every day to the private group, take some trades on there on futures. So if you want to become better at trading futures or just need some more insight into ICT trading, that resource is directly available to you. Enjoy this type of content, leave a like and I would greatly appreciate it. Until I see you next time, good luck and good trading.